Welcome to Turning Point's Clearway Capital Solutions podcast series, where we talk to leading investment managers and general partners in their respective asset classes about the evolution of their markets and how they're responding to these changes. Established in 2008, Clearway Capital Solutions is an independent and privately owned company providing business development and capital advisory services to investment managers in alternative and traditional asset classes who are seeking to engage with Australian and New Zealand investors and their consultants. The Turning Points podcast series provides listeners with direct access to the insights of our investment partners.
Today we are joined by Bob Kricheff, Global Strategist and Head of Multi-Asset Credit for Shenkman Capital. Bob joins Dennis Mathonius, Managing Director of Clearway Capital Solutions, to discuss how the rapid build-out of AI infrastructure is reshaping credit markets, from investment-grade issuance by hyperscalers to emerging opportunities and risks in the non-investment-grade market.
Bob, let's start by reminding the audience who Shenkman Capital is and what they do.
Sure. Shenkman Capital, we just celebrated our 40th anniversary. We are a credit shop. We do virtually everything there is in below investment grade credit. Everything from senior secured bank loans to convertible bonds and structured credit. We are very much a bottoms-up focused shop. We've have a very disciplined and repeatable credit research approach, which we feel is really part of our DNA. And all the products that we've built out and all the differentiated services that we offer are all based on the strength of that research. And then over the top of that, we overlay a lot of portfolio construction, understanding of different marketplaces, and obviously the uses of all kinds of technology and risk analytics as well.
We're hearing a lot about well-known tech firms seeking to issue debt to fund AI projects. Why are these cash-rich giants suddenly leaning so heavily on debt?
Well, there's certainly a lot of funding requirements right now. There's a lot of uncertainty how far these funding requirements are going to go and what's going to be needed. And if you look in the investment grade market, which is thus far has been their approach to AI has been fairly different than what we're seeing in the below investment grade market. They, as you said, Dennis, they have huge pools of cash, but they're also being able to issue debt at very, very low costs. So I think it's a risk management exercise where they're able to issue very low cost debt in the investment grade market for fairly long maturities and still have that strategic advantage of having all that cash in case they need to pivot or in case situations develop that they want to go after. Because I think one thing is, as we talk about, what's going on out there in the markets, we'll see is people may have a path and a view of where AI is going, but a lot of it is unknown and we don't really know which route it might take. And I think having that flexibility is what those big companies are really going after.
Bob, can the credit markets absorb all this anticipated issuance, and what are the risks?
Yeah, it's a great question, especially since we see a $30 billion deal in the market today for Oracle, and we continue to see issues coming. Right now, it appears that the markets are, I think, talking a lot about it. About how much they can absorb, but they are absorbing it. When you think about the really strong, large capital names that issued a lot of debt last year, like Meta and Microsoft, those types of levels of issuance of 10, 20, 30 billion got a lot of headlines, but they were absorbed very well from the market. The global investment grade market is very, very large. And these companies have a lot of other sources of cash flow. So I think thus far, the investment grade market has been very accepting of these large issues and probably could absorb more. Obviously, we've seen some more volatility around some of the issues from companies like Oracle and a few others. But even those have settled down after a while and have not seemed to impact the market largely. I do think it is interesting because even in as large as the investment grade market is, this issuance by all these tech companies is starting to change the makeup of the market. Technology is now a much larger portion of the market. One thing we're very used to in below investment grade markets where we operate and where we invest is that the markets change all the time. This is a little bit of a newer phenomena in investment grade market because these markets tend to change less over time. If you just think about it, the average maturity in the investment grade market is more than 10 years. So you're talking in theory almost, 10 years to turn over the whole market. The average maturity in the high yield market in the levered debt markets is about 4 years. So you're talking about almost 20 to 25% turnover a year. So you can get a lot of change in the below investment grade market, and we're very used to that. Whereas I think it's a little bit of a difference for the IG market with this rapid change.
Bob, we'll get to non-investment grade markets in a second, but what can we learn from Oracle's debt issuance?
So Oracle has had a couple of debt issuances in the past year, and then another one, this month and today. And I think some of what we can learn is there's a few takeaways from it. First of all, there are, you can't always lump all tech companies together. There are a lot of different business models, and certainly Microsoft has a varied business model. Amazon has a varied business model. Meta has a varied business model. And Oracle has a very different business model, and they've been very, very focused on databases. So I think generally, people viewed where their moats are and where their risks might be different than some of these other companies that may be a little bit more diversified, like an Amazon or a Meta, or have different revenue streams away from AI. And there was somewhat more anxiety, I think, in the market about where the future of the company is going, and probably a greater level of unknowns, at least as perceived by the market. I think the other thing may be the messaging about their issuance and how quickly different issuance came to market. We noted in this most recent issuance that they were very clear to kind of lay out in their comments that they anticipated that there was going to be a fairly long period of time before they expected another debt issuance. So I think some of it is certainly because of the business differences in a business model like Oracle versus some of the other large AI players in investment grade, but also the messaging to the investment community about what to anticipate in funding needs and the timing of it, I think, have been a big factor as well with Oracle.
As hyperscalers dominate investment grade credit issuance, is risk cascading into high yield markets, and could this issuance in both markets cause an AI credit bubble?
I think IG companies and some of these also more developmental companies that are still private are finding various creative ways to finance their needs, and really in some cases using other companies and other companies' balance sheets to finance some of their needs as well. And some of that issuance is finding its way into the below investment grade market. So while I don't think it's very likely that some of this big issuance that's going on in the investment grade market that we just talked about is necessarily coming, to put pressure on the below investment grade market. But I do think that we're starting to see some changes in the below investment grade market by these venture capital companies and these large companies looking to partner with other companies to help build out some of their infrastructure. So what we're seeing in below investment grade is companies that are issuing debt to help service part of the AI supply chain, if you will, and part of the development of AI. The analogy that is probably overused, but is they're sort of building some of the and selling some of the picks and shovels, but not mining for the gold.
What are AI-linked high-yield bonds, and where do the risks lie there?
Sure. There's a number of examples of issuers that have come to the market, such as TeraWulf and others. Interestingly, a lot of these have issued in other markets. For example, TeraWulf we knew from the convert market, and now there's sort of convergence, and it's been issuing to build data centers and such in the regular way high yield market and outside of the convert market. I think most of what we're seeing has been data center related in the high yield market, where companies have been basically funded or guaranteed or have contracts to build either new data centers or infrastructure to help support data centers. But AI has also affected other companies that were already existing in the high yield market. So some of the telecommunication companies have seen a big lift in some of their demand for their fiber as they interconnect some of these different services that the companies are using to develop AI and some of these data centers. So while there is some direct issuance that we've seen in AI companies that are involved in that infrastructure and sort of the supply chain, if you will, a lot of what we've seen thus far is other existing companies being impacted, thus far primarily in a positive way, by AI-related revenue within the below investment grade market. That doesn't mean that we won't start to see more issuance in companies that are directly related, but it may take some time before that becomes a substantial portion of the market.
Shenkman Capital is known for its bottom-up credit-intensive approach in leveraged credit. How is the firm thinking about AI-related issuers differently in this cycle, given the combination of massive capex, longer payback periods, and uncertain monetization?
Well, I think when you're a below investment grade investor, the number one thing you have to think about is you have to be skeptical. You have to always be questioning, what can go wrong? What am I missing? Is there a fatal flaw here that I'm not looking at? And that's just the nature of being a good below investment grade investor. But, the fascinating thing about what we've seen come to market so far is each transaction is different. It's not like you're looking at a whole bunch of companies that are exactly the same. So I think it's really critical to see, number one, what past track record can you look at that this company can execute their plans? Do they have any experience? Can they show it where they're fail-safes to be able to make sure if things go wrong, they can get back on track? The other thing is structural. Who are they partnered with? What part of the chain are they building? What kind of guarantees or other contractual obligations they have, and how strong are those that they have? So I think you have to be fairly selective in these and very analytical in where they end up in the food chain and what guarantees they have and what they can do structurally going down the road. So the partnering, the structure, the guarantees that you have all become very, very important. In some cases, when you're building up a bottoms-up model, the revenue, competition, all those things can be of value to look at. But here, I think structure has a higher ranking in what you have to look at in these early stages for artificial intelligence-related credits in the leveraged finance market.
If the AI build-out proves slower or less profitable than expected, what do you think the stresses will show up first in high yield?
I think it's going to be in those companies that are in the developmental stages, and also in those companies that hit some, blocks going down the road. It's unlikely that every company that is involved in building these type of services for the AI industry will not have some problems. And it's that company that gets delayed or has cost overruns or other problems that'll be most sensitive. And I think that's one of the reasons of getting to know management, getting to understand the history of the company, getting to understand the structure is really important. Part of our process is we have to talk to company managements. We have to, make sure we touch base with them regularly. And really in these kinds of companies where so much is going on and there's so many important pieces to it, keeping your hand on the pulse of that company and where the developments are becomes more and more important. And also not being afraid to change your thesis if things change. So I think it's the companies that will have really problems with execution, and even a small one could make you fall behind and make you lose some partners. So I think diligence is really going to be very, very key for figuring out which of these companies are going to have some problems, because as you alluded to in your question, at some point there's going to be a slowdown. At some point there's going to be a misstep, and you want to make sure you're in the credits that have the best pieces together to make sure that they don't get hurt when those missteps happen.
Bob, more broadly, what's the risk to corporate credit from the adoption of AI?
Yeah, that's as fascinating a question as how does AI develop and how do all these new companies come into the markets? The biggest thing about AI is it increases the unknowns for corporations. It increases the threat. It increases the potential for cost benefits. It potentially changes the competition that these companies are facing. So I think first and foremost, companies are going to look at ways to make money, to save money in their production. That seems to be where we're hearing about it the most. Thus far, we're not necessarily hearing a lot of stories about, hey, I'm developing a new revenue source, or I'm developing a new business line using AI outside of the AI companies. When you think about it, with the internet, we ended up with, kind of destroying some of the geographic roadblocks. So we ended up being able to have internet sales, internet retailing. You didn't have to go to a movie theater to watch anymore. You could stream it, and you created whole new businesses. It's early days yet, but we haven't seen that happen in AI. So right now, on the positive side, it's mainly cost savings. On the negative side, it's also, we've heard a lot of concern, but we haven't seen it happen yet. But the question of a moat getting destroyed, a company that thought they had an industry lockdown and a customer base lockdown, and AI allows a competitor to come up with a better product, or the clients start to use AI to develop a product that replaces that customer internally. And those moats could get destroyed very rapidly. Right now, I think most of it is questioning and speculation, but these are the kind of things in our morning meetings, in our credit meetings, we're constantly talking about to try to get a sense of where those risks may come from. It's going to happen. It's just hard to tell exactly where it's going to come from and which areas are going to get hurt the most.
Turning to private credit, there's been a lot of chatter about increased M&A activity in 2026, which many believe will be dominated by private equity-led LBO issuance. Where will these transactions get financing, and is private equity's first preference likely to be private debt markets?
I think, you'd have to ask the private equity guys to get the real answer. But I think from my seat, I think they have preferred to go to the private credit route for several reasons. And often it's because you can get your financing in one lump sum, you have fewer people to negotiate, et cetera. But look, there's different transactions depending on what they want, where they might be able to get better pricing or more flexibility in the covenants if they go to the public markets in the bond market, or the fully syndicated market in the loan market. So there will be situations where they will tap those other markets. I also think when you're looking at very, very large transactions, you're more likely to tap the public markets and utilize both the high yield market and the loan market on a fully syndicated basis. But I think you're going to see a lot in all of those different markets. We do expect private equity to increase the M&A transactions. We also expect to see more corporate to corporate transactions as well. Thus far, I know it's early days in this year so far, but we've actually been seeing more corporate transactions coming to market than private equity. But I think we're going to see both. I think there's a lot of opportunities. I think also to build up competitive positions, as we just talked about, to fend off threats. Some of this M&A issuance will be really valuable from a strategic point of view, and that's why we're starting to see some corporate M&A as well. And look, we talked about it before. The M&A is another way the market changes. AI issuance starts to change the market, and M&A starts to change the market as well as we see these new issues come into market. And we've definitely been starting to see a little bit more of that those type of transactions coming to the market versus just refinancing like we saw primarily in 24 and the first half of 25.
That's interesting. U.S. money center banks have developed creative ways to enter private debt markets over the last 18 months. In December, the U.S. rescinded the leverage lending guidance for U.S. banks. How might this impact credit markets and particularly private credit?
It's a great question. I mean, I'm not saying that one caused the other, but when those leverage lending guidelines were put in place, several years ago, it did kind of coincide with the growth of the private credit markets that really took off in the last, 6-7 years. I think the rollback of those will not be a dramatic change. But it does give the banks another arrow in its quiver, gives them more flexibility. And I wouldn't be surprised if it becomes easier for them to do bridge loans and bridge financings and compete more with some of the private credit markets where they can come in and offer a quick solution and then decide what market to go to afterwards, whether they take that bridge out with private credit and maybe, as we know, some of these companies do have partnerships for private credit in place already, or perhaps they can go to the fully syndicated loan market or the high yield market or some combination of all three. But I think an increase in use of those bridge loans can give them more flexibility in doing this and make them more competitive versus private credit.
Bob, what other changes should we look for in credit markets in 2026?
Well, we talked about M&A and we talked about new issuance coming from AI. So I think those will definitely be changes. I also think we could see more fallen angels. Last year we saw the largest dollar amount of fallen angels since 2020. There weren't as many names. There were some very large ones that were fallen angels, but I think we could see more names coming into the market, not necessarily because of credit problems as much, but I think to some extent of corporate actions. If we see more spin-offs, more splits of assets and so on, parts of those companies may come into our market. And I think that's very, very likely to also be a source of changes in the market. I also think we've seen more corporate actions, whether those are levered dividend deals or other transactions like those spin-offs that I talked about, that could also start to lead to new issuance in the market. But I think what we're really seeing between all of the things we talked about is a period where we're likely to see the constituents of the leveraged finance market start to go through a change. If you think about it, as I mentioned before, 23, 24, first half of 25 was refinancing of existing names. We saw several trillion come to market, but they weren't new names necessarily coming into the market. That's what we started to see in the latter half of 25, what we expect going forward. And it's likely to come from all these different sources and create some real opportunities in the levered finance market in coming years. But it's also going to require a lot of selectivity, I think, as well, to really be able to get that alpha and outperform.
Thanks, Bob.
Thank you, Dennis. As always, a pleasure chatting with you.